High dividend ETFs. Are they worth it? Most people chasing dividend ETFs are actually losing money without realizing it. And I'm about to show you exactly why. What's up? This is your friendly neighborhood finance guy. And today we're breaking down the high dividend ETF trap that's costing everyday Americans thousands in opportunity cost. By the end of this video, you'll know if dividend ETFs belong in your portfolio, or if you're better off doing literally anything else with your money. Let's go. Part 1. The Dividend ETF Trap. Here's what happens every single day on Reddit, TikTok, and finance forums across America. Someone discovers a dividend ETF like SCHD or XYLD. They see it pays 4, 5, sometimes 6% annually in dividends. Their brain lights up. Free money, right? Wrong. Let me give you real numbers. Say you throw $50,000 into XYLD, a covered call ETF that yields around 8%. You get $4,000 in dividends that year. Your friends are jealous. You feel like a genius. But here's what nobody tells you. That 8% yield? It's not coming from thin air. It's coming from the fund's principal. The stock price itself is getting demolished to pay those dividends. Over the past 3 years, XYLD returned negative 0.7% annually while the regular S&P 500 returned 14%. You didn't just miss gains. You actively underperformed by 15 percentage points every single year. That's 45% you left on the table. On $50,000? That's $22,000 you didn't make. This is the dividend trap. High yield looks sexy, but you're essentially paying your principal to yourself while the core investment atrophies. Part 2. The tax nightmare you didn't expect. Now it gets worse. If you're holding dividend ETFs in a regular taxable brokerage account, not in a Roth IRA or 401k, every single dividend payment is a taxable event. Let's say you're in the 24% federal tax bracket. That $4,000 dividend from XYLD, you owe $960 to the IRS. In some states, you owe state taxes too. So you're really making $3,600 after taxes. Except the stock price still dropped. Compare this to the S&P 500. The SPY or VU pay dividends too, around 2%, but the rest of those returns come from price appreciation, which you control when you sell. You pay capital gains taxes only when you want to, not forced. This is tax inefficiency on steroids. And here's where it gets criminal. Most people buying dividend ETFs are beginners. They stick them in regular Robinhood or Fidelity accounts instead of maximizing their Roth IRA. Contribution first. That $6,500 limit for 2024. If you're not maxing a Roth IRA before buying taxable dividend ETFs, you're doing this backward. Full stop. Part 3. When dividend ETFs actually make sense. Okay. I'm not going to sit here and say dividend ETFs are always garbage. They have a place, just not where most people think. First scenario. You're over 55, retired, and you genuinely need monthly income. If you've got $2 million and you're living off it, taking a modest 4% dividend makes sense. You're not trying to grow anymore. You're managing what you have. Second scenario. You're using them inside a Roth IRA or 401k. Inside a tax-protected account. The dividend tax doesn't matter. You can grab that higher yield without the IRS taking a cut. SCHD inside a Roth IRA? That's actually smart. The tax drag disappears. Third scenario. Psychological. And this is real. Some people will not invest unless they see cash hitting their account monthly. A dividend ETF forces discipline and makes investing feel tangible. If SCHD is the thing that gets you to invest consistently instead of sitting in cash, then it wins. even if it slightly underperforms. But know what you're trading. The real play. 90% of people between 22 and 45 should not be touching dividend ETFs at all. Here's the better path. Max your Roth IRA with VU or VTI, total market index funds that return around 10% historically. That's tax-free growth forever. Then max your 401k if your job offers it. Another $23,500 in 2024. Then if you've got more money, throw it into a taxable account with VU or VTI. Wait until you're retired to harvest those dividends. The math is brutal. Someone who invests $25,000 yearly at 15% returns will have $1.8 million in 30 years. Someone chasing 6% dividend yields? Around $1.1 million. That's $700,000 left behind. For nothing. So are high dividend ETFs worth it? Only if you understand you're sacrificing growth for yield. And most people aren't making that trade consciously. They're making it because a TikTok account made it look cool. Don't be that person. If this changed how you think about dividend ETFs, hit that subscribe button. We break down money moves every week that actually move the needle. Thanks for watching, and I'll see you in the next one.